The tech stock bubble has burst. Has the time really come for the end of the tech sector boom? At the beginning of the year, everything seemed promising. A report from Morgan Stanley predicted that the global tech market could reach $5 trillion in 2023, representing 8–10% growth compared to 2022. Sales of tech stocks were breaking records, despite increasing macroeconomic challenges. But if we fast forward just 7 months, the news paints a very different picture. The world's largest tech fortunes have lost billions as the market slows down. Several of the world's richest tech billionaires have suffered significant losses. Elon Musk, founder of Tesla and SpaceX, who was once the richest person in the world, has lost $10.8 billion from his fortune over the past year, dropping him to third place behind Jeff Bezos and Bernard Arnault. Has the tech bubble burst? Apple and Microsoft showed significantly slower growth in the first quarter, especially in the Asian markets, where declines occurred. Similarly, Google and Amazon faced significant difficulties in China, causing billions of dollars in losses for the leading tech companies. Due to the slowdown in growth for Amazon Web Services and Meta's lower revenues, Amazon shares lost 9% of their value as the company cut its 2024 forecast. Before this, Apple also suffered significant market depreciation after seeing a 16% drop in revenue over a 13-week period. Alphabet, Google's parent company, also saw a 10% drop in stock price due to declining advertising revenue. The most concerning factor was that all of them faced slowing tech demand, exacerbated by macroeconomic uncertainties. Interestingly, the prevailing opinion among investors was that tech stocks were relatively recession-proof. The primary customers of tech companies are high-income corporations and investors who are generally less sensitive to economic downturns. Their purchasing power remains relatively stable, allowing them to continue spending on tech products even during recessions. But why are we seeing such a significant decline in the tech stock market in 2024? I recently read an article that notes global data shows that U.S. households earning less than $50,000 a year make up about 27% of regular tech consumers. This is almost as large a group as those earning more than $150,000 annually. Surprisingly, lower and middle-class consumers make up nearly half of the global tech market. This segment is expected to grow to 450 million by 2025, up from 390 million in 2019. This is the result of several factors. On the one hand, more consumers in developing economies are entering the middle class. On the other hand, it is a direct consequence of the COVID lockdowns and government stimulus programs. While the media spread images of economic hardship and suffering, for many, this period was actually financially favorable. Personal savings rates skyrocketed, putting a lot of money into people's bank accounts. Added to this was the increased tech presence on social media, which drew attention to new devices, along with tech companies' efforts to offer entry-level and mid-tier products. All of this resulted in a rapid increase in middle-class tech spending. Looking back to the pandemic period, we can see that tech purchases by individuals earning less than $50,000 were 365% higher by the end of 2021 compared to January 2020, before the lockdowns began. In the US, tech spending has also shifted toward younger age groups. Millennials and Gen Z generated all of the personal tech market growth in 2022, and they are forecasted to dominate tech spending by 2030. Over the last few years, oddly enough, tech devices have become more accessible than ever. However, this also means the tech sector is no longer immune to economic changes, as the middle class is far more sensitive to macroeconomic conditions than the ultra-rich. The buyers of tech products are largely not ultra-wealthy, but upper-middle-class people who enjoy spending. If these people have less disposable income, as is currently happening, it will negatively impact such discretionary purchases. Two regions that account for a significant percentage of the tech market are the US and Europe, and it is no secret that the middle class in both regions is under severe pressure. Now that the macroeconomic environment has deteriorated and inflation has taken hold, the purchasing power of the middle class has significantly declined. Due to high interest rates and inflationary pressures, tech companies are now facing decreased demand. In the US, the federal funds rate increased from 0% to 5.5%, while the European Central Bank similarly raised interest rates, making it harder for consumers to purchase new tech products. Higher interest rates have made borrowing more expensive, and consumers are cutting back on their spending. Demand has dropped most for tech products considered luxury items, such as smartphones, premium laptops, and other high-end devices. Tech companies like Apple are particularly sensitive to this change, as sales of new iPhones and MacBooks are one of their biggest revenue sources. Due to declining global sales, Apple's stock has also come under significant pressure. The US federal funds rate has risen from near zero to 5.5%, and the European Central Bank, ECB, has similarly raised interest rates from 0% to 4.25%. These measures were, of course, taken to reduce inflation, which had become evident in both regions, though for slightly different reasons. While these measures have proven effective at cooling inflation, they have made life more difficult for businesses and individuals. Mortgage interest rates have increased, debt repayment has become more difficult, and although unemployment generally rises in a high interest rate environment, this has not happened to the same extent. Overall, however, consumers are spending less, which naturally cools inflation. This is how the economic mechanism works. Typically, the first things to be cut back are unnecessary large expenses, such as premium tech devices, smartphones, laptops, gaming devices, and cloud services that aren't strictly necessary. This is evident in the results of major tech companies like Apple and Microsoft. But let's now discuss the sector's biggest challenge. While every significant region is contributing to the slowdown in tech product sales, the largest impact is being felt in China. Between 2017 and 2021, China's tech market experienced enormous growth, with the tech sector tripling in size. However, this boom came to a halt in 2022, primarily due to COVID-19 and the strict pandemic measures imposed by the Chinese Communist Party. With the easing of restrictions in December 2022, the beginning of 2023 seemed promising, with the tech sector showing 12% growth. But the good times ended there, as 2024 painted a completely different picture. Chinese consumers are currently in a tough spot, and this could cause significant problems for the world's largest tech companies. Upon exiting the COVID lockdowns, unlike the Western world, the Chinese government did not launch widespread stimulus programs. As a result, people are facing financial difficulties, particularly in the real estate market. In China, 70% of household wealth is tied up in real estate, compared to Western countries where wealth is distributed across various asset classes, such as stocks, bonds, and real estate. The fall in property prices in China has caused significant wealth loss for middle-class families, and consumers are spending their money more cautiously, especially on tech products. As a result, tech companies like Apple, Huawei, and Alibaba are facing serious challenges in the Chinese market, which was previously one of the world's biggest growth drivers. Products like the new iPhone models, which once enjoyed huge demand in China, are now seeing more cautious buyers, and this is a worrying trend for the major tech companies. Chinese consumers are increasingly pulling back on spending on expensive tech products, which is also evident on Chinese online stores like Alibaba's platforms. Apple and other major tech brands are being forced to offer discounts on their products to clear out accumulated stock. The average discount on Apple products, for example, reached 50% in 2024, compared to just over 30% the previous year. Discounts and the cheapening of brands raise serious concerns. Frequent price reductions on tech products can damage a brand's prestige in the long run. As Jack Angelito Perez Tan Jr., CEO of RTG Group Asia, put it, while discounts may help with short-term stock sales, frequent price cuts can make brands too accessible and deter their most valuable, premium customers. This is especially true for major tech brands with strong brand power but who are not immune to the effects of recessions. Top-tier brands like Apple or Tesla generally hold up well, but the larger market reacts more sensitively to economic changes. As Apple's example shows, their brand is not just built on popularity. Apple does not rely solely on its brand recognition but has created a closed ecosystem, where the integration of products and services makes it difficult for users to switch to other brands. Visa and MasterCard operate similarly, using network effects to strengthen their market position. In conclusion, the tech stock market is facing a major correction. Brand value can be a huge advantage, but it doesn't always provide protection against economic downturns. The tech stock market is facing significant challenges due to the global economic slowdown and declining consumer demand. For major tech companies to remain competitive, they will need to strengthen their market positions through new methods, such as building network effects or ecosystem-based business models. The future won't be easy for the tech sector, but strong brands and well-established ecosystems may be able to weather the storm and return to a growth trajectory in the long run.